This video covers accounting for long-term debt. We'll first go through some terminology. Terminology is a bit of a heavy lift here. And second, we'll go through the steps of how you account for issuing long-term debt, and in particular, bonds. So first, the terminology. First of all, a bond is a financial instrument. And another way to put financial instrument is that it's a piece of paper that a company agrees to. It's an agreement. It represents the company's formal promise to pay a principal amount and interest to the bondholder. And the payments are made on a defined schedule, ending at the maturity date. So first of all, what is the face value? So we mentioned principal up here. That's another word for face value. Face value has a couple of different synonyms. Face value, principal, par value, maturity value. This is a lump sum payment. It's a cash amount to be paid by the company borrowing the money to the bondholder at the moment of the maturity date. So it's a one-time payment from the company to the bondholder at the end of the bond's term, the maturity date. The coupon rate is also known as the stated rate or the contract rate, and that determines the interest that an investor in the bond will receive. So an investor in the bond will receive coupon payments during the term of the bond. And the coupon payments are based on the coupon rate, which is stated usually in terms of an annual interest rate, and it determines the cash payments that will be made by the company to the bondholder for each year that goes by during the bond's term. So these are the aspects of a bond that investors are very interested in. They want to know how much cash they'll be receiving if they invest in this bond. Now let's talk about the market, which is the investors who are interested in buying the bond from the company. The market determines an effective rate, or a market rate. This is different from the coupon rate. This is again an annual interest rate, but it's not the amount the investors were going to receive from the company. It's the rate of return that investors want from the company when they buy this bond. So it's an interest rate. Investors, they determine it to be their required rate of return, otherwise known as their yield, at the time of the bond's issuance. That's the effective rate. The fair value, or the market value, is what they calculate based on the effective rate. It's the price that investors are willing to pay for a bond, and it's equal to the present value of all of the bond's cash flows, so the principal and the interest cash flows. The investor will discount those cash flows using the effective rate, and they'll come up with the fair value of the bond. What are they willing to pay for that bond? Okay, so that's some terminology. Now let's go through the steps of accounting for a bond. Step one relates to the initial issuance of the bond. When a company issues a bond, they sell this piece of paper, this agreement, to an investor, and the investor gives cash to the company to borrow. The company will observe how much cash they receive and record an initial liability equal to the cash proceeds from issuance of the bond. So the company receives cash, debit cash, and credit a liability account called debt for that same amount. That's step one. Step two involves what a company does as time passes and they're still borrowing this money. No, they record interest expense for each period. And the interest expense is a calculation using the effective interest method. How does a company calculate interest expense? They'll take the effective interest rate. So remember, the effective interest rate is the one that the market determines. So a company needs to figure out what that effective rate is. And they'll multiply that effective rate times whatever the beginning of period book value of the debt balance is to arrive at interest expense. And we'll go through an example of how this is done. So the company will calculate interest expense. And as time passes, what else is the company doing? Well, they're making coupon payments. So they'll also be making coupon payments at the same time they record interest expense. And the difference between the interest expense we just calculated and the coupon payments that the company makes is going to amortize the book value of that liability, the debt account. And that book value is going to amortize towards its face value. And you'll see how that happens in our example. So those are the three steps in accounting for a bond. And here's the example we'll go through. So we'll use Allbirds. The hipster shoe company is going to issue a pretend bond. This bond has an issuance date of December 31st, 2018. And it has a face value of $10 million, a maturity date of December 31st, 2020, and a coupon rate of 5% paid every year end. And the reason I put this shape around the bond is because it's an agreement. The company is going to sell this sheet of paper or this agreement to interested investors. But now let's put ourselves on the investor side. So now we're going to contemplate investing in Allbirds by letting them borrow our money. So how much should we pay for this Allbirds bond? First, we need to figure out, if I agree to this, how much cash am I expected to receive from the company? Well, that's determined by the contract. So you can convert the terms of this bond into a payment schedule, which is exactly the cash flows the investors are expecting to receive. First of all, they're expecting to receive that face value of $10 million. They're expecting to receive that amount at the maturity date of the bond, which is December 31st, 2020. So they expect to receive $10 million 2 years from now. They also expect to receive coupon payments or interest payments along the way. How much are they expecting? Well, they're expecting 5%. Well, if you take $10 million face value times a 5% coupon rate, investors are expecting to receive annual interest payments, so once per year, interest payments of $500,000. So at the end of December 2019, 1 year after they buy the bond, they'll expect to receive their first $500,000 payment. And at the end of the second year, they'll expect their second $500,000 payment. So you see that $10 million just converted. At the end of the bond's term, how much does Allbirds have to pay the investor? $10,500,000. Because not only do they have to pay off the face value, they also have to make the 2020 interest payment for borrowing that money during 2020. Okay, so the purpose of going through this procedure was to see what investors are thinking when they read a bond contract. They immediately convert it to a payment schedule. Now we need to, so this payment schedule, that's not what the bond is worth. I'm going to show you now how to convert that payment schedule into what an investor should be willing to pay for the bond as of December 31st, 2018. So an investor is going to receive a payment December 31st, 2019 and another December 31st, 2020. We need to convert those into what are they worth today to know what an investor should be willing to pay today. For that, we need to discount those cash flows. So this slide is just to introduce you to discounting cash flows. Suppose you invest and so this is a different example. Suppose you invest $100 in a bank account, and the bank account promises to earn you 10% interest for 1 year. How much money will the bank account be worth at the end of the period? And the way you calculate that is you take the $100 and you multiply by 1 plus the interest rate, which is 0.1. 10% is 0.1. And you actually have to raise this quantity, everything in parentheses is 1.1. You need to raise that quantity to the number of periods that you're waiting, that the money is going to be earning interest. And so for this example, we're only going to raise it to the first power. And so 1.1 to the first power is still 1.1. So 100 times 1.1 is $110. Oh, that's ugly. Let me do that again. $110. So if you invest $100 and you wait a year earning 10% interest, that investment will be worth $110. You can also calculate a present value here, and that's the formula I'm showing you. So the present value is calculated as the future value. So the present value, by the way, is this $100. That's the value at the beginning of the process. So at the beginning of the year, this investment's worth 100. At the end of the year, it's worth 110. The present value is equal to the future value divided by 1 plus the interest rate raised to the power of n, where n is the number of periods. So let's go through how this is computed in this case. The future value here is $110, and we'll divide by 1 plus the interest rate raised to the power of n, where n equals 1, because it's just the 1 year period. If it were 2 years, we'd raise it to the power of 2. Okay, so when you go through this calculation, 110 divided by 1.1 raised to the power of 1, yes, you do indeed get $100. And so this is just how you calculate the present value of a future cash flow. So the present value of a future cash flow. Okay, that's the end of this little tangent. And now let's go back to that bond. So Allbirds is now going to issue this bond, December 31st, 2018. Investors see the cash flow list. They see the terms, they convert it to a cash flow schedule, and then they decide, what am I willing to pay for this? Well, investors buying this bond require an effective rate of 7%. So this is just an assumption here, but investors want a 7% rate of return. So here's how they'll discount those cash flows. They'll take the future values and they'll divide by 1 plus the effective interest rate, which is 0.07. The first payment, the denominator will be raised to the first power because it's being discounted by 1 year. And so how much is a $500,000 payment worth a year from now at a 7% interest rate? It's worth $467,290 today. Similarly, with the $10,500,000 payment, we divide by 1 plus 0.07. This time we raise the denominator to the power of 2 because it's being discounted 2 years. Remember, it's December 31st, 2018, and this payment occurs December 31st, 2020. So we get 2 years of compounding interest. That's why the exponent here is a 2. And what is the $10,500,000 payment worth 2 years from now at a 7% effective interest rate? $9.1 million. So when you add these two amounts together, this is what an investor today, December 31st, 2018, will be willing to pay for this payment schedule seen here. So that's the amount Allbirds will receive if they issue these bonds. So when Allbirds issues the bonds, they're going to receive cash of $9,638,000, and they'll record an initial liability, step 1, for the amount of cash proceeds. So credit to the debt account, a liability account for $9.6 million. Okay, that's when we issue the bonds. Now let's have a year go by. It's now December 31st, 2019, and the only thing that happens now is that Allbirds needs to make a coupon payment. Allbirds has been borrowing this money now for a year, and you can't borrow money for free. You need to make interest payments. So they're going to make a coupon payment on December 31st, 2019. How much of a payment are they going to make? Well, we've already calculated this before. You take the face value of the bond and multiply it by the coupon rate to get the coupon payment. So $10 million is the face value. The coupon rate is still 5%. And so the coupon payment is $500,000. Now we need to calculate interest expense, and this is the bulk of step 2 here. How do we calculate interest expense? You'll take the beginning book value of the liability and multiply it by the effective interest rate to arrive at interest expense. So let me back up here just to the previous slide and show you the beginning book value, which is right here. That's the book value of the liability. And in December 31st, 2019, that's considered the beginning book value because it's a year ago at December 31st, 2018. So fast forward to this slide again. The beginning book value is that $9,638,396. The effective rate is determined at issuance. It's locked in. It was 7%, if you remember from the previous slide. So you take the $9.6 million, multiply it by 7%, and the accountant gets an interest expense of $674,000. Here's the journal entry. A debit to interest expense of $674,688, and a credit to cash of $500,000 for the coupon payment. Remember, the third step in accounting for bonds is to have the difference between these two amounts amortize the debt balance. So the plug to this journal entry is a credit to the debt account to balance the journal entry, and a credit to the debt account is going to make the book value go up by $174,688. So let's take a look at the balance sheet after December 31st, 2019. Remember, a year ago, December 31st, 2018, we had a book value of $9,638,000. Now we've recorded an interest payment and interest expense, and we've amortized the book value up to $9.8 million from 2018 to 2019. And that book value is going to continue amortizing up towards its face value, which, if you'll remember, is $10 million. So that's the end of 2019. Now let's let another year go by, and now it's 2020. And we'll split December 31st, 2020 into two parts because two things are happening on this day. First, Allbirds is going to make another coupon payment, and second, Allbirds is going to pay off the face value because this is the maturity date. So first, let's make another coupon payment. Face value times coupon rate is the coupon payment, $500,000. Interest expense is calculated in the same way, but the beginning book value is now different. The beginning book value is now $9.8 million. We'll multiply that new beginning book value times, again, the same effective rate, and now we'll get interest expense slightly higher, $686,916. So here's the journal entry. Again, we debit interest expense for $686,916, and we'll credit cash for $500,000. And same as before, the difference between these two amounts, again, amortizes the debt balance up towards its face value. This time, the difference between these two numbers is $186,916. So now let me show you, before we move on to part B, which is making the maturity payment, let me just show you the debt T account. So I'll show you the debt T account over the entire bond term. At the beginning, the liability account called debt was at a credit balance of $9.6 million. We amortized it up a bit in the first year to $9.8 million. And then we just now amortized it again, and now it's up to $10 million. So the bond book value has amortized up to its face value. And now the last journal entry is quite simple because we need to make our final maturity payment of $10 million. And we've got a $10 million balance in our debt account. So when Allbirds pays off the face value, simply debit the debt account for $10 million, reducing it to zero, and credit cash because Allbirds has to pay off this bond with cash. Okay, so we've gone through that example and we've implemented these accounting steps. So to recap, to account for a bond, upon issuance, the company records an initial liability equal to the cash proceeds from the issuance of the bonds. That's the fair value that an investor determines they're willing to pay for the bond. That's the amount of cash the company gets, and that's the amount that the company records as a liability. Then each period that goes by, a company calculates interest expense for each period, and it's equal to the effective interest rate, so the interest rate that investors were using to discount their cash flows, times the beginning of period book value of that debt balance. A company will also compute the interest payment, and that's equal to the face value of the bond times the coupon rate. And then in step 3, the difference between the interest expense and the cash coupon payment is going to amortize the book value of the bond towards its face value.